Welcome back to the deep dive. Today, we're trying to get inside the head of a financial legend. We're going to be looking at the public filings of Stanley Druckenmiller, and we're zeroing in on one particular purchase from Q3 that, honestly, it seems pretty bewildering on the surface.
Yeah, it really does. And this isn't just, about a stock pick. It's about trying to read the tea leaves when a titan of finance, someone known for these huge, successful macro bets, makes a really counterintuitive move.
A move on an asset that, frankly, it looks like everyone else is running away from.
Exactly. And for anyone who might not know his full story, Druckenmiller is really in a league of his own.
He is.
He ran Duquesne Capital Management for almost 30 years, from 81 to 2010. His average annual return was over 30%.
Over 30%. But the truly amazing part is that he never had a losing year.
Never. Not once.
Think about that. He navigated the '87 crash, the dot-com bust, 9/11, the 2008 financial crisis, and not a single calendar year in the red. That track record just proves he has this almost uncanny ability to see these big structural shifts coming.
Absolutely. And you see it in his pedigree. He was a protege of George Soros, and he was a key player in that famous, that massive trade against the British pound in 1992. The one that basically broke the pound.
Right. $1 billion trade. So his style is, it's all about high conviction. When he sees an opportunity, he doesn't nibble. He makes these huge concentrated bets. So our mission today is pretty clear. We're going to dive into the sources on his Q3 moves, get the big picture, and then try to figure out what on earth he sees in his most intriguing new position, StubHub Holdings.
Okay, so to start, let's just lay out the context of his overall activity. We get this information from the quarterly 13F filings with the SEC. It gives us a snapshot of what these big funds held at the end of Q3. It's not real time, but it's the best look we get.
So what was he up to?
Well, he was definitely busy. On the buy side, his top three positions were the biotech company Insmed, a big stake in the iShares MSCI Emerging Markets ETF, and Amazon.
Amazon. That's a big tell for broader market sentiment. And what was he selling?
His biggest sells were Philip Morris, Entegris, and Coherent. So sort of more old economy, maybe interest rate sensitive type names.
Okay, so let's unpack that for a second, because that's the essential context for this whole StubHub move. What's the macro signal there?
Well, if you look at the buys Amazon and an emerging markets ETF, it points to a bet on global growth.
And resilience, right?
Exactly. Buying Amazon is a vote of confidence in the U.S. consumer and big cap tech. Buying an emerging markets fund is a bet that, U.S. interest rates have peaked, which is usually good for global stocks.
And on the flip side, selling a company like Philip Morris, a classic defensive high-dividend stock, suggests he's moving away from safety. He's looking for things that will do well if the economy speeds up, not slows down.
Precisely. The whole portfolio is shifting toward global growth and maybe a little bit of optimism. And that's the lens we have to use when we look at this StubHub purchase, ticker STUB.
Which the sources call his most intriguing new position.
Yeah.
And intriguing might be an understatement. I mean, this wasn't a small flyer. Druckenmiller bought 4.26 million shares. That is an aggressive, high-conviction move.
It is. Even though we don't know for sure if he bought in the September IPO or if he got them on the open market after it started trading. And that brings us right to the core paradox here. The reason this is so fascinating.
Because he bought this while the market was just, it was brutalizing the stock. You pull up the chart and it is a disaster. The IPO was September 16th at $23.50 a share, and it just fell immediately.
It really did. It just kept dropping, and it hit a new low in mid-November, trading just under $11.
So let's just put a pin in that. The price today is around $10.83.
Meaning in about 2 months, the stock lost more than half its value. It completely fell off a cliff.
So the question for you and for us is this. Is Stanley Druckenmiller, the guy who never lost money in a year, catching a falling knife here? Or is the market so wrapped up in the short-term noise that it's missing some huge long-term value that only he can see?
To answer that, you have to look at the bull case. Why would he even be interested? And StubHub isn't some new startup. It launched way back in 2000. It basically created the secondary ticket market. For years, it was the undisputed leader.
It's got that brand name. I remember when eBay bought them for, $310 million? It's a foundational company in that space.
And that history feeds into the business model, which is the kind of thing a macro investor would find very attractive. It's scalable.
Right. It's a classic two-sided marketplace.
That's book example. They connect ticket buyers and sellers, a very clear need, and they take a fee from every single sale.
And the magic of that model is the operating leverage.
Right. That's it. Exactly. The main expense is the technology, the website, the app. So as more and more people use it, the cost of each additional sale is tiny. So as it grows, the profit margins should just get wider and wider. That's the kind of financial setup that attracts big money.
Okay, but if that's the case, why did the stock collapse? We have to look at their first earnings report as a public company because something doesn't add up.
Right, because the numbers,
Yeah.
they weren't just okay, they were actually pretty good. Third quarter revenue was up 8% to $468.1 million. And importantly, that beat what the analysts were expecting.
And what about the total value of tickets sold?
That's GMS, or gross merchandise sales. That rose 11% to $2.43 billion. But here's the detail that likely caught the eye of Druckenmiller's team. The company said that if you adjust for the huge once-in-a-lifetime impact of Taylor Swift's Eras Tour,
Oh, right. You have to back that out.
you do. And when you do, their GMS growth was actually up 24%.
Okay, let's just pause there because that's a huge difference. The market sees 11% growth and yawns. But the core business, without the biggest tool on the planet, is growing at 24%. That completely changes the story. It suggests the underlying demand for live events, sports, concerts, everything is still incredibly strong.
It absolutely does. It points to real fundamental health. And on top of that, their profitability improved. Adjusted EBITDA was $67.5 million, up 21%.
Okay, for anyone not deep in finance, what's EBITDA and why does that matter here?
It's just earnings before interest, taxes, depreciation, and amortization. It's basically a cleaner look at a company's core operating profit.
It strips out the accounting noise.
Right. And their adjusted EBITDA margin actually got better. Went from 13% to 14%. So that margin expansion plus the 24% underlying growth, the business is working. It's moving in the right direction.
So if the financials are solid, if they're beating expectations, and the core business is growing that fast, why the 50% sell-off? This has to bring us to the headwinds, the challenges.
And the first big one is just competition. StubHub isn't the only game in town anymore. Not by a long shot.
They're fighting a war on multiple fronts.
You really are. You've got the giant Live Nation's Ticketmaster, which controls so much of the primary market. And then you have other really strong marketplaces like SeatGeek, who've really connected with younger buyers.
And that competition has to be squeezing them. But that wasn't the trigger for the immediate stock collapse, was it?
No. The thing that spooked Wall Street was very specific. They gave no guidance for the fourth quarter. Yeah. Despite the good Q3, management wouldn't give a forecast. And analysts hate uncertainty more than anything. So most of them just reacted by slashing their price targets, and that's what created the intense selling pressure.
That short-term uncertainty is one thing, but it's made worse by these much more serious external threats, right? The regulatory stuff.
You're absolutely right. The biggest long-term cloud over the business is coming from the UK. The Financial Times is reporting that the UK government is seriously considering a ban on selling tickets for more than their face value.
Wow, that's an existential threat to their model, isn't it? The whole point is market pricing.
It's huge. The sources say it could put a significant dent in their UK business. It fundamentally attacks their main revenue stream in a major market.
So that's a massive risk just hanging over the stock.
A massive risk. And on top of that, the UK's Competition and Markets Authority, the CMA, has launched a formal investigation into their pricing practices.
And this is where the market complaint meets the everyday consumer experience. They're looking into drip pricing and pressure selling.
Exactly.
We've all seen it. You find tickets, you go to checkout, and then suddenly all these service fees and handling charges get dripped in, and the price is 25% higher.
And then there's the pressure selling, those misleading countdown timers. Only 2 tickets left at this price to rush you into buying. The investigation itself is a bad look.
So, okay. StubHub is not the growth juggernaut it used to be. You've got intense competition and this huge regulatory threat from the UK that could really slow them down. It's a heavy cloud.
But now let's get back to the valuation, because this is probably where Druckenmiller saw the opportunity. After that 50% drop, at a market cap around $4 billion, the stock looks, well, reasonably priced at about 15 times its run rate EBITDA.
Reasonable price doesn't sound like a Druckenmiller bet, though. He goes for huge upside. How does he justify a 4.26 million share position with that kind of regulatory risk hanging over it?
That's the billion-dollar question. For the stock to recover, the company absolutely has to give investors some clarity on their growth and how they'll handle the UK situation. Druckenmiller is essentially betting that they will, and that the market has overreacted to the regulatory fear.
So this is where you have to zoom back out to the macro picture, his other big buys.
Yes. This move seems to fit with the optimism we saw from his Amazon and emerging markets buys. It suggests he's looking right past the Q4 guidance miss and the short-term regulatory noise. He's playing the long game.
And what is that long game? Is it just a bet on human nature?
I think so. Essentially, it's a bet on the enduring demand for live experiences, concerts, sports, theater, that fundamental need to go out and do things. He sees a world where discretionary spending holds up, and he's looking at the long-term value of that demand, while everyone else is panicking about short-term problems.
Okay, so let's try to sum this whole thing up. We have a legendary investor making a massive contrarian bet. He's buying a market leader that has a great scalable business model, but that company is facing brutal competition and a government regulation that could cripple its business in a key market, all while the stock is near its all-time low.
The bull case for StubHub is very clear on paper. The margins, the strong core financials, that hidden 24% growth, it's all there. But the regulatory environment in the UK is the one huge unpredictable variable. It's going to either prove him right or, completely undermine the whole thesis.
So here's the final thought for you to chew on. Druckenmiller is known for his conviction. He doesn't make these bets unless he's extremely confident. And he made this purchase after the stock had already been crushed by 50%. So if the fundamental business is as sound as the numbers suggest, how much pain should an investor be willing to take while waiting for all this regulatory and competitive dust to settle? What long-term signal about the future of live events and consumer spending is he seeing that the rest of the panicked market is missing right now? Something to keep an eye on.